Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, welcome everyone. You're listening to Your Money Momentum. My name is Tom Kennedy, and I have Kevin Curley here. Kevin, what's going on?
Tom, it appears the IRS does not take summer vacations. They are busy issuing all kinds of new rules about the Secure Act. They say you can take an emergency fund without a penalty. They're changing the rules about inherited IRAs and clarifying them. So while everybody else is on the beach, the IRS is out there issuing rules left and right.
I guess they weren't affected by this crowd strike and the shutdown with the blue screen of death.
My wife's car's in the shop, and they were like, we can't work on it today because we don't have a computer. It's like, wait, what do you use the computer for? What does that have to do with fixing a cable? Hold shocking. On. Yeah.
Well, for our next pod, maybe we'll do a whole conversation around those changes that are potentially in place. But for today, we'll talk about a topic that comes up quite a bit, and that is how much do you need to retire and what type of strategies that you have in place to do that. We'll do our central bank roundup, talk about some interest rates and conversations there, and then we'll end with our something or nothing segment. So let's jump into the planning topic. So Kevin, how much do I need to retire? And what does that look like?
I'm going to give you the answer every accountant gives to every client when they ask a question. It depends, which I learned that one from Ben Murphy. But today I'd say let's focus on withdrawal rates. And so people have heard of the 4% rule. There's been a lot of studies done and says it works pretty well over a 30-year horizon. What I found, and this comes from some research done by Michael Kitces, is that real number is actually 3.6%. If you're working with an advisor who's charging an advisory fee and also account for taxes, that you can expect a 50-50 asset allocation over 30 years to work every time. Now, there are a couple exceptions. Those exceptions were countries you wouldn't be surprised by. So if you closed your stock market and had, let's say, a communist revolution, didn't work out. If you were one of the belligerents in World War II, Japan and Germany, didn't work out during that period. But otherwise, we found that the safe withdrawal rate, that magic number, is not 4%. It's actually 3.6%.
So let's elaborate on that a little bit. When you say 3.6%, you have an IRA, you have some investment accounts, you roll over a 401k, you take all your investable assets that are in the market and you draw a 3.6% rate of return off that. So if you have $1 million, you're looking at $36,000 a year in income.
That's exactly right. And so this safe withdrawal rate is focused on your portfolio. And so if you think of a balanced asset allocation, which the classic one's the 60-40, which we've talked about before. And somebody like yourself might say that portfolio is dead, but for all the research, it does say, hey, it has worked. And hopefully the future, not predicted by the past, but it's a pretty good guide to say, okay, well, what has worked in the past? Has it worked to have this type of portfolio? And the answer has been that the answer is yes. Now, when you're building out your retirement income, you want to get it from multiple places. So let's say you do that quick math and you use 3.6 or use 4% just as a benchmarking before you do a full financial plan with, a CFP like Tom or myself. And you kind of go, well, am I close? Am I in range? And you go, well, I'm not quite there for what I need to retire. What you might find is, well, what if you add in Social Security and wait until your full retirement age? What if you also have a pension at work, or maybe you have passive income from a rental property? And if not, are you willing to do some type of part-time work? And that's kind of how we build the retirement income picture.
Yeah, and I think the whole idea that the biggest challenge is no one knows how long they're going to live. So the only way to guarantee you don't outlive your money is to have some sort of fixed rate that you can live off of. Let's just use 4%. And really the idea is if you're drawing 4%, you want to live off of the dividends and interest and not touch the principal. But the idea is if you take 4, hopefully the account is growing by 5 or 6. So each year you get kind of an automatic step up. If you're taking a fixed percentage and that $1 million goes to 1.1, well, now you're getting 4% of a higher number. So it works really well. Everyone's different. We've stretched it out higher to 5 or 6%. But the more conservative you are, especially when you first retire, the first year or two is detrimental. One, it's new. You have to budget. You're replacing your salary, so you kind of ease into it, and you can increase that, decrease that. But yeah, the 3.6, I haven't heard that one, but it makes sense.
Yeah, I think that one of the things to point out when you say you take out 3.6, you take out 4 per year, it's from that day you retire. So let's say you retire at 62, which half of America does, and you planned a 30-year horizon, so living until 92, which would put you definitely winning the longevity game, but not the biggest winners as far as people, some get to 100. But that first year you take out that 3.6. When you increase it the following year, you don't base it on what the balance is for, if performance was good or performance was bad. You only increase it based on what inflation was. So a couple of years ago, we had high inflation rates of 7-8%. And you probably saw with Social Security, they increased through their cost of living adjustment a pretty significant amount. Prior to that, most years it was zero or a very small amount that they were increasing that number. So if you did have $1 million and took out 40,000, well, next year, let's say inflation was 4%, we're only going to increase that 30,000 by 4%. So it's not going to go, well, now the account's $2 million, I'm going to take out 80. No, to make this work, because we want to be ready for this technical term, bad timing. We have to be ready for that, for those bad years where we have like a 2022 where both stocks and bonds fall, or you have a year like '08 or 2001 where they fall tremendously and they stay down for a while. To be able to survive through that, another key part is rebalancing. So having a strategic asset allocation or having a manager that makes sure that, hey, this portfolio is still in line. So it is not that simple, even though we try to make it simple and kind of have a rule of thumb.
Yeah, and it's a good point. There's something called sequence of returns, which essentially is just kind of luck of the draw. Clients that retired in 2007 versus clients that retired in 2012 had a whole different experience because you had a massive market crash versus a almost 10-year run where the market went straight up. And one thing that we spend a lot of time on is stress testing the portfolio to say, okay, well, what happens if inflation goes up by 5%, Social Security gets cut, taxes go up, and you have a bad market environment? Can you still retire off of this dollar amount? So we always want to leave a significant cushion because we don't know what the future holds. We don't know what inflation is going to do. We have, educated guesses and we have ideas, but it's so important to stress test the portfolios prior to that date. And sometimes you might find out that, maybe I do need to work another year or two, or I need to drastically cut back on my savings or just my expected income and what that's going to be. And it's usually a combination of all the above.
Yeah, and along those lines, you mentioned that taxes, they can take a big bite out of your return. One of the reasons we encourage people to wait until they take money out of the IRA is, if you're going to pay a 23 or even a 30% rate on taxation, that's as if the market fell 30% this year. And if you felt that, it would feel awful, right? But you do that every time you take money out for taxes. So having, we'll say, tax diversification. So if you have a brokerage account, a traditional IRA, a Roth IRA, a passive income investment that has rental property that maybe you get to take depreciation on, you have personal savings, and you have all these different buckets to pull from, you can be very clever to keep your overall tax rate low.
Yeah, that's a great point. I mean, it's all about net at the end of the day.
Mm-hmm.
And, the majority of folks, most of their money is pre-tax. So there's not much you can do about that. You're going to be at ordinary income. However, you should be at a lower tax bracket in retirement. But to your point, there's definitely a strategy behind where you take what money when, because it's all about tax sensitivity at that point.
Yeah, and it's never too late to think about taxes. So even if you already are retired, there's some things you can do, like a Roth conversion to convert some of the money. Maybe it's a bad year in markets and you say, I want to convert certain parts of my portfolio. Or you say, well, I'm not going to work this year. I might retire. I might take a hiatus for a year, a sabbatical, so I'm not going to have very much income. It can make sense to convert some of that money now and pay those taxes at a 10 or 12% rate, knowing that in the future it might be higher. And the other part is that investment income that you get off your IRA, that's taxed as ordinary income, right? And so that gets too high, they're going to include Social Security as part of your taxable income as well. If you keep that number low, let's take it out of Roth, out of personal savings, and only a little bit out of the IRA, you might have a Social Security benefit that's not taxed at all, which is better. What do
Yeah,
you want?
and that's a whole other. There's 464 different ways to take Social Security. Most of us know, three. It's 62 the
Wait, I thought
earliest,
there's early,
66 or
on time, and
67.
late. What are the
Yeah,
462 other ones?
that's what I'm saying. 62 is the earliest, 66, 67 is full retirement age, and 70 is the last. But there's a lot of different ways to take Social Security, and that's part of the financial plan. And again, everyone's different. Everyone's in a different position. But I mean, it can't stress it enough. It's so important that you have the right distribution strategy, and that doesn't mean, hey, I'm about to retire next week. There's planning that goes on before that to make sure, to your point, Roth conversions and moving around different buckets to make sure that you have the most tax efficient strategy.
Yeah. All right. So we go see what our glorious central bankers are up to.
Shine those boots. It's time for
Ooh, doggy.
Central Bank Roundup.
Let's do it. So, interest rates. A lot has taken place over the last couple of weeks. I follow something that the CME Group puts out. It's just what the bond market is pricing in for what the Fed's going to do for interest rates. If they're going to keep them level, if they're going to hike, or if they're going to cut. And for the first time in a while, the last couple of weeks, there is almost 100% chance that the Fed cuts rates in September. There's a 93.5% chance that there's a 25 basis point cut. There's a 4.6% chance that there's a 50 basis point cut, and there's a 1.9% chance that they leave rates where they're at. Now, these numbers change on a daily basis, but a lot of this comes off of the recent inflation numbers that we've gotten. They're coming down. The unemployment rate is going up, which is what the Fed wants to see. So it looks like we're going to get from what the bond market's telling us, that we're going to get a couple cuts this year.
Yeah, what I've seen is priced in two for this year, seeing September as well, even though some of the Fed speakers have been out on tour going, well, we're ready, but we're not ready quite yet. So it is only July, give them 2 months, they'll probably be ready by then. It seems that they are eager to cut, and they've even said like maybe even four next year. So, cutting interest rates by 1.5 would be helpful for a lot of different people, whether it's high yield companies looking to borrow or people looking to refinance their mortgage. One of the things that happened in the most recent report was Powell even mentioned the scariest word out there, which is deflation. So the inflation rate fell, and he said there's actually some deflationary impulses, which can be, problematic, but projected that we'll reach that 2% magic number sometime in 2025 or 2026. So at that point, they don't want to risk a recession. They'll cut rates to get growth back going once inflation is under control.
Yeah, the question we get asked, or I get asked a lot at least, is when do they stop cutting? And I think the neutral rate, in my opinion, is probably about 3%, 1% over inflation. Which if they get to 2, then the Fed funds rate's going to be at 3. That last decade that we saw at 0% was an anomaly. It was way too low for way too long. I think everyone realizes that. I don't think we'll ever go back to 0. And if we do, it's because we have a massive recession and it'll be short-lived. But I think they'll get, we're at 5.5 right now, 5.25. I think getting down to 3, everyone's happy. Money's cheaper. Less is more, and they're in a tight spot. And I've mentioned this multiple times, but just the interest rate bill that we have, that the Fed has to pay every month, is $80 billion a month. They're going to hit $1 trillion this year just in interest rate payments. So they need to cut for no other reason than that alone.
Well, reputationally, what they usually do is they wait too long to cut the first time, and then they have to cut aggressively because they held it high too long and caused a recession. So, fingers crossed that doesn't happen this time. But let's go quickly abroad. We're going to not talk about the ECB and some other people because we want to focus on China. That seems to be the hottest game in town. Not unlike the US, but in a much more extreme way. They're having a bit of a regional banking crisis. They've had a ton of banks get closed down. They're having their central bank, the PBOC, intervene in their currency as well as their bond market to try to basically manipulate it for their own benefit. Most of this is coming from a collapse in housing and other real estate, and the lenders of all those are primarily regional banks, and they are having their S&L crisis, whatever thing you want to use from U.S. history. it's happening over there right now, and they have some major challenges. So, what is the impact you think for the global economy if they are having this crisis? Is it something that can be ignored? Is it something we got to take note of, Tom?
No, I think it definitely can't be ignored. I mean, say what you want about China. Outside of the U.S., they are second in line for their participation in global GDP. So a lot of growth comes from there. Look up Google ghost cities. I mean, it's amazing what they've built over the years, where there's these massive cities, everything from malls to buildings, and there is no one that's ever occupied them. So they did this massive infrastructure and this massive spend, which some would argue was why their GDP was so high, and there's no one living there. So China kind of comes in and out, I feel like every 3 or 4 years, about this slowdown. And, they make up a significant part of global GDP. So I think it is something.
Yeah, no, it's definitely something to watch. And what's funny is that right across the sea from them, the Bank of Japan loves to intervene. They're very active. They had yield curve control. They did all that. China primarily kind of just wings it and says, well, every once in a while we'll do something. But oftentimes they're acting with their central bank to achieve political goals. Same thing with that buildup you were talking about of having all those ghost cities. Well, that really helped. That helped with investment, jobs. So you had a ton of people working, doing things. That helps with keeping the peace and keeping stability. So they're not always, we'll say, capital motivated. Sometimes it's more political motivated. But let's move on to our final segment, something or nothing.
Let's do it.
So we're going to stay in China for this first one, and actually get over a city we all know, which is the city of Wuhan, famous for their potluck lunches of millions of people, apparently. So the future is here, Tom, but it's not evenly distributed. Baidu, which is, we'll call it Chinese Google, probably not quite as good, but they have 300 robo-taxis in operation in Wuhan. They have no driver, no humans involved. Is Chinese tech going to beat the US on something? Or them getting their robo-taxis rolling around sooner than the US, something or nothing?
Well, there's robo taxis here in the U.S. I think they're in 4 cities. It's San Francisco, L.A., Las Vegas, and Phoenix. And funny enough, in San Francisco, they had a robo taxi that hit someone, ran him over, and 5 minutes later, another robo taxi came and dragged that person 20 feet. So there was a lot of controversy.
That's not a good thing to laugh about. I hope the person's okay, but the idea of these robots just coming in and causing problems is what we're all afraid of. That's the first thing they did.
I mean, that poor person. What are the odds of getting hit by a robo taxi? Can't get up, and then another robo taxi comes and drags you 20 feet. So
not great. These robots are already coming for us, Tom. We just let them out on the streets.
There's been a lot of talk about these robo taxis. One is just they're just not profitable right now. They're just way too expensive. The technology that's involved, but there's a lot of countries right now that are investing in it. The Saudis just put $100 million into a Chinese startup called Pony AI. I think eventually they will be here, just like everything else, but it's just a little too. I'm not getting in a robotaxi anytime soon. Let's just say that.
Yeah, it would depend on the type of car, right? If it's a Volvo that has this reputation for never having any fatalities, all right, maybe I'll hop in. But yeah, Chevy Cruze, no thanks. I'd like to get there safely more than without a driver.
It better be a dump truck. That's the only way I'm getting in a.
Dane Cook had a joke about that. He was going to buy a dump truck and put all his buddies in there, just rumbling around in the back. It'd be the best drive. You'd pad it, of course, so you could bounce around, but it'd be a lot of fun. And yeah, anyway.
Yeah, there's I also read that China is actually starting to sell some of this autonomous technology because they are ahead of the curve than the rest of the world, and they figured they could probably make more money selling it to the U.S. and the U.K. and everyone else. So we'll see. I feel like the Chinese are always a step ahead when it comes to tech.
They're hustling.
All right, so let's jump over to India. Stock market's hitting all-time highs India's been growing like crazy for the last couple of years. What are your thoughts there? Is this something that we should take note of?
Yeah, I think the way I think of it is India is having a moment. They're on the headlines everywhere. One of the richest families there, I think it is the richest, the Ambani family, is having a wedding, and they've flown in elites from all over. Even Mike Tyson is there. Justin Bieber performed, Rihanna performed. Like it seems like quite the party, a good time. They're shutting down traffic. They kind of own this one like area, and they literally shut it down that part of the city for this wedding, which is wild. And like you said, the stock market's hitting all-time highs. They just had an election that went off not without a hitch, but the result exactly wasn't what it expected, and things are okay. And then even Martin Wolf of the Financial Times is kind of suggesting that India is going to become a superpower. It's a matter of when, not if. So I think it's definitely something that we should pay attention to. It's something that is real. And, if the US and Russia are going to fight over Ukraine, and China and the US are going to fight over Taiwan, once we all get done destroying each other, India might be the only game left in town. So they could end up as the sole superpower uh, after those kind of wars take place. But in the meantime, they just seem to have a lot of action going on. Economy is growing, I think, like consistently for like 15 years. They've been close to double digits. And it seems sustainable as well. I mean, the number of people going from, say, poverty to lower middle class to middle class and further, I mean, those tailwinds can really go for a while.
Yeah, I mean, it's one of the fastest middle class growers in the world right now. I mean, they have what 1.4 billion people
Hmm.
in India. Talking about GDP, I mean, they've been growing at 7-8% clip year over year, which is massive. And depending on where you look, and I don't know if people just can't get good numbers or not, but they rank anywhere from 3 to 5 on the contribution to the percentage of global GDP. So they are definitely something. And if you look at some of these projections of where India is going to be over the next 5 or 10 years, it is definitely something.
Yeah, and a lot of it's low hanging fruit. So Procter and Gamble is over there, and one of the things they're trying to do is get people just to use detergent. And so they're going into all these villages and trying to come up with pods and go, here's how you use this. And so when you have a consumer products company that goes in and goes, this is our chance to sell people soap and other toothpaste and basic items like that, and now they have the disposable income to buy those. I mean, we know the playbook, just, right? We kind of know what people want and kind of expect, and a little bit better in healthcare. And, a lot of this is low hanging fruit to, proper sanitation. Like, this level of development,
Well,
you don't require AI chips. It's basic stuff. So I think tailwinds
yeah,
can really go for a while.
yeah, and there's so many companies outsource. I mean, you look at the big four CPA firms; they
Mhm.
all outsource all of their work to India. And there's tech, and there's a lot going on. So they're on the radar for sure.
Yeah. All right, Tom, we're going to go to another continent, our third one or maybe the fourth for the podcast. The European Central Bank, commonly known the ECB, has issued a warning over shadow banking risks. So specifically, Elizabeth McCall, who is retiring at the end of this year from her supervisory role, cites the Archegos incident, which, as a reminder, one guy basically took to a bunch of different banks and said, here, I have collateral. Can you let me borrow? And did that loan several times, which is obviously fraud, but he was able to get away with it. She cites the long-term capital management collapse as evidence that private firms and private credit, when things go wrong, don't stay private problems. And it requires, whether it's the Fed or the ECB or some other regulatory body, to come out and do something about it. So, Tom, is this just a parting shot from a frustrated bureaucrat, or is this a wise warning from a central bank soothsayer?
No, I mean some of these firms, like the one you just mentioned, I mean they were 10 billion in size. So these are big numbers. And shadow banking, for those of you that may sound familiar, I mean that's one of the reasons that led to the great financial crisis.
Mhm.
It's all shadow banking is. It's basically a financial institution that's not a bank that does lending. So think hedge funds, insurance companies,
In this country, it's a lot of private equity.
mortgage lenders, in private equity, investment bankers, private credit. So, people don't want to just rely on going to a traditional bank for lending. So there's other sources of it. And, you look at the hedge funds in our country, I mean, Citadel and Millennium are 120 billion in assets combined. So this has been going on for a while. I don't think there's the leverage in the system that led to the great financial crisis. But I don't know. I don't know if it's something or nothing. I mean, you would have to have a lot of these. private institutions go belly up for it to make like you said, go from private to public as far as the impact goes. But it's been going on for years. I don't think anything's going to change. It's less regulated. It's essentially just private lending. So I think she's more frustrated than anything. I don't think it's a huge issue.
Yeah, I understand what you're saying. I think that maybe some of it is, whether it's the Fed here or the ECB there, they say, well, yeah, we do oversee the banks and we make sure that they have the right, capital to withstand losses and so forth. But these private credit and private groups, they don't oversee them. They don't have to go in there and make sure they have proper collateral. So if things go wrong there, somebody is going to have to be involved to fix the problem when it happens. And I think ultimately the frustration from somebody like her is, you guys are going to call us to fix this problem, but we don't have any oversight to prevent the problem from becoming a problem in the first place. So she had some good examples. I think Archegos and long-term capital management are great examples of where you had problem, but they were able to deal with them and they were small. So maybe there's a key, like not too big to fail, but a certain minimum size that you go, okay, well, now we have to come see your books, whether you're the ECB or the Fed, even if you're not a bank.
Yeah. The whole too big to fail. I mean, 2008 was a great example when Bernanke and Hank Paulson locked all the big CEOs into a room and told them they weren't leaving until they figured this out. So $2. I think if it ever gets that bad, I'm not overly concerned about it. And by the way, these institutions are part of the reasons why the world goes around. They give lending to people that can't normally get lending, and they can have very significant returns as well. So not an issue.
Well, speaking of lending, our final kind of prompt for today is Peloton, the famous cycling company. They also have a rowing machine, a treadmill, and all kinds of things going on. They recently raised funds through the issue of a convertible note, which is a new type of financing for them. They previously just issued shares when the stock was high at much higher levels at one point. This time they got to pay 5.5% to get $350 million just to keep their operations going. So is there kind of a canary in the coal mine here? Is Peloton's change in their ability to raise cash unique and a problem for them, or are we going to see this from a lot more firms going forward?
No, doing a convertible note isn't necessarily a bad thing. There's a lot of reasons why a company will do it. But when you have a company like Peloton, which, by the way, they hit $167 a share during the whole 2020, the meme craze, and everyone was buying a Peloton because no one could go out. It is now down to $3.63 a share. It's dead. I think this is their last lifeline, and issuing 5.5% convertible note, which all that is, it's a loan that converts into equity. I mean, you dilute the shareholders, you start losing control of the company. And this, in my opinion, is basically their last lifeline. Maybe they're hoping that they are a takeout target and get bought out, but this is only going to get them so far. I haven't looked at their balance sheet and I don't know what it looks like, but I can't imagine it looks good. So something for them for sure, but you see convertible notes all the time on the business side, and there's reasons why you do and don't issue them.
Well, I hope they survive. I've got a 27-week streak. I'm trying to keep going on that bike. So if I'll be the last one using it, hopefully 270 weeks from now. But I just hope they keep it going, because otherwise I got to start over with some other thing, right? And got to hit reset.
Yeah, you might. Maybe after you're done with your Peloton, you can go walk over to Blockbuster and get a nice
there's
DVD
still one
watch.
left, right? It's in Oregon. We'll make a pilgrimage at some point. Go back and.
Is there really one left?
There's one left.
Huh.
Yeah, I don't know if they have VHS or DVD or what's in there, but there's one. it basically should be a museum or a mausoleum, right? So.
I still have that smell when you walk into that place.
Yeah.
What a great childhood memory, Blockbuster.
Right? Yeah. Well, they did have a chance to buy Netflix and declined. So maybe they possibly regret a thing they didn't do. How about that?
Jeez. All right. Well, we'll end there, and maybe in a couple of weeks we'll pick back up with some of these tax regulations that you were talking about on the front end, and some of the things that are possibly coming down the pipeline.
Sounds good.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.